Welcome everybody to BDO's webinar focused on professional service firms. My name is Anna Gerald and I am the tax partner leading our professional services tax team in the UK. For those of you who don't already know, BDO is a global accounting network with over $9 billion in revenues in 162 countries and with over 80,000 people. Our speaker today is Ishvinder Bedi. Ishvinder is an Associate Director in our VAT team focused on professional service firms. You can ask questions during the webinar by using the Q&A feature on your screen, and we will address as many questions as we can at the end of the webinar, or if time does not permit, after the webinar. We'll also record the webinar and we'll email you the slide deck as well as the link to the recording in a few days' time. And we will finish within the hour. I will now hand over to Ishvinder.
Great. Thanks, Anna. So just to pick up on the agenda, so there's a number of points that we wanted to raise today. First being making tax digital for VAT and how that's coming along and what you need to be thinking about. Disbursements, we want to pick up on VAT groups because there's been some recent changes on that. Place of supply, particularly land-related services, because obviously that is always a hot topic, as well as other hot topics which are deal fees and Brexit. And then to close off, there's a couple of areas that we want to pick up on in regards to some changes that would be worth considering for your business. So going straight on to Making Tax Digital. For those who don't know, Making Tax Digital is the flagship project for HMRC, where they are trying to fundamentally change the way in which taxpayers really report and deal with HMRC. Right now, if you're just dealing with VAT, you have to log in and submit your VAT return numbers by manually entering 9 boxes into their portal and then submitting that to HMRC. Going forward, or if you have already implemented it, you're required to be able to submit those 9 boxes via what HMRC call an API to basically feed that data directly to HMRC and then also get data coming back from HMRC to confirm receipt. Now, it's fair to say that at the moment you only need to submit 9 boxes, but this is really HMRC's first foray into what we expect to be their push towards real-time reporting in VAT and generally around taxes. And this has been seen across other countries and across the EU in particular, where they've implemented such rules. So MTD really only applies right now to any business that has taxable turnover in excess of £85,000, which is the VAT registration threshold. And it was meant to start from the 1st of April 2019 for any business that could potentially, well, for any business. But then a deferral was introduced going for periods on or after 1st of October 2019 for businesses that are seen as complex. And that would be businesses that are part of a VAT group, that are on payments of account, or are non-UK established. So what do you really need to think about? So first of all, there's a requirement to have what HMRC call functional compatible software. And this is effectively, the definition of this has effectively changed over a number of years. So the main requirement for functional compatible software is that the VAT registered business must be able to record and preserve certain types of records and certain data in software. And that needs to be seen as functional compatible software. Now, again, what is functional compatible software? That's changed slightly, but fundamentally is anything that can really record and preserve digital records and can also submit that data in terms of the 9 boxes to HMRC via an API, and then also receive that information from HMRC as well in terms of confirmation receipts. Now, before, that was not meant to include spreadsheets or Microsoft Excel, but HMRC have said that spreadsheets can qualify for now. Obviously, given this was a climb down, we don't know how long HMRC would expect that to be in place going forward. But fundamentally, you really need to be able to have a complete set of digital records across a range of different software, but be able to show to HMRC that you have all the detail that you need to keep digitally. Now, one of the wider issues that's come across as a result of MTD is one of digital links. Fundamentally, as part of becoming compliant with MTD, HMRC expect you to have a VAT return process that is effectively digitally linked. And what is that? That is basically ensuring that your VAT return process is from end to end, so from the extraction of your data from your system to the submission of your 9 boxes to HMRC, that is all digital, and that there is no manual adjustment, with the exception of some adjustments that we can mention later. But there is basically minimal manual intervention or transposition of data, and if there is transposition of data, that is done via digital means. So that can include things like an automated data transfer, CSV imports, and even potentially linking cells between 2 different spreadsheets in Excel. But what can't be allowed is a manual copy and paste of data. And now that can often be complicated for a number of different entities, for example, VAT groups, where a number of different companies will prepare their own VAT returns and then submit them centrally to the head office for them to then collate everything manually and then file to HMRC. So the question is, from that, how do you make sure that your VAT return process is digitally linked, particularly when you're dealing with multiple entities? And so what have we seen that has really kind of come up from a number of clients that tends to be an issue? So one thing that we've identified is, for example, reverse charge transactions. So these are obviously purchases coming in from overseas where you have to apply the reverse charge, i.e. you account for input tax and output tax at the same time. Now, a lot of systems that we've dealt with, particularly in the professional services industry, do not automatically account for VAT. It is for an accountant to identify those transactions and then manually enter in that VAT into their VAT return. Going forward, that won't be compliant with MTD. You also need to be able to have certain amounts of summary data, which is basically your total output tax on your sales, VAT on acquisitions, which is specifically relating to purchases of goods coming in from other EU member states, VAT on reverse charge, on input tax claimable on business purchases, and also on acquisitions, and also total VAT payable or reclaimable following any sort of error, corrections, or adjustments. And then finally, we mentioned any other adjustment that needs to be processed, which we're about to go into. So one of the things that I think maybe took HMRC by surprise when they were implementing MTD was actually the amount of businesses that still rely on Excel and still have to make some sort of manual adjustment to their data. And that is because of sample checking of invoices, and that can actually just be because they are a complex business. So there are certain adjustments that businesses are required to make as part of being compliant with VAT, and that relates to, for example, partial exemption. So if you make VAT-exempt supplies, you have to restrict your input tax recovery, and that is rarely done in systems. That is typically done manually by some calculations in a spreadsheet. You can also have the fuel scale charge, which is a way of you accounting for VAT on fuel provided to individuals, where they can potentially use that for private use. And also the capital goods scheme, which is an adjustment scheme that allows you to monitor and adjust your VAT recovery on large capital expenditure over the course of 5 to 10 years. Again, now those aren't done through system because they are complex and they are highly manual calculations. I haven't seen any system that actually has managed to do those, and so it's unreasonable to expect any business to be able to have that done automatically in a system, particularly if you have a special method. So the question that came about is, then how would you go about making those changes? So after some consultation, HMRC looked at the matter and agreed that you can make these changes in a separate spreadsheet if you need to, and then you can include the final figure for adjustment in your VAT return. So those kind of adjustments are allowed, but generally speaking, if there is a mistake on your VAT data, or if there's a certain amount of transactional data that isn't being reported correctly, then that would need to be corrected in system in order to be MTD compliant. So what are some of the other key issues that we've identified, particularly with professional services industries? So one thing that we've identified is the utilization of incorrect tax codes. So obviously when you are attributing a purchase or a sale and you're adding that to your system, you're meant to allocate a certain tax code in order to ensure that you're accounting for VAT correctly. We've seen often in professional services firms that there is an ability to use the wrong tax code, and primarily an international tax code, which basically means that it doesn't get necessarily reported on a UK VAT report. Now that needs to be corrected, obviously, in order to ensure that the data that is feeding in to the preparation of your return is correct. Going forward, we wouldn't expect that to just be a manual change that you can then just reverse out when you're preparing your VAT return calculations. As we mentioned, manual reverse charge calculations. So if your system isn't set up to be able to apply the reverse charge, i.e. if it can't account for the VAT itself, then HMRC would expect you to enter in two transactions, one as a purchase and one as a sale. Now, obviously, as long as you're fully taxable, those two should net off, and it should allow you to effectively account for the reverse charge. But the key is also then being able to identify if the figures are going into the right boxes and that the transaction, either as a sale or a purchase, is also going in your sales and purchases boxes. And then more widely speaking, is looking at what adjustments are you making to your VAT return process, how manual is it, how much data do you feel you have to transpose manually, how much data are you getting from various systems or from other systems other than your ERP systems. You know, it's looking holistically at your VAT return process and thinking, are there any points where you don't think you're going to be compliant with MTD? Now, obviously, we can potentially support you with that if need be, but first step is really just mapping out your VAT return process and looking at whether you think that will be compliant with MTD. And then more widely speaking, so in terms of general readiness for MTD, some key questions that we think you should be asking beyond just the actual preparation of the VAT return and how that's being managed. Obviously, we mentioned that if you are seen as complex, you are subject to a deferral where you can defer implementation of an API for VAT periods on or after the 1st of October 2019. And then you have a soft landing period of a year, so until periods up to October 2020, for you to ensure that you have your digital links in place. Now, if you are subject to that deferral, you should have a letter from HMRC, because HMRC have said that that letter is the thing that gives you the right to defer the implementation of MTD. That being said, they have changed their position on that because they have known that actually they haven't issued letters to every entity or every VAT registered person that is affected by the deferral. So they have climbed down on that somewhat, but our advice would still be make sure you have a copy of that letter on your files. We obviously mentioned the point around your VAT return process and if that's digitally linked, but also whether you think that you potentially need an extension. So one of the most recent changes to HMRC guidance on this matter has been the introduction of rules around requesting an extension from HMRC. Now, they have said that they can allow extensions in certain circumstances where they think that the implementation date, either 1 April 2020 or 1 October 2020, is too onerous for taxpayers. And in that case, you can ask for an extension. But they have said that just simply the excuse of saying a cost of implementing a system would not in itself be reason to request an extension. So you really need to consider whether you think the requirements are too onerous for the business, and that needs to be done sooner rather than later, because obviously what you don't want to do is request an extension right to the end of your implementation of digital links. In which case, obviously, if it is rejected, then you won't necessarily have enough time to ensure that you have your VAT return process compliant with MTD. So it's doing that review in good time to make sure you're comfortable that you can submit a request for an extension if you need to in time. So that's everything on MTD. We also wanted to pick up on disbursements because obviously there have been a few cases over a number of years on this matter. But to start, I thought it would be helpful to really set out what HMRC's position has been on disbursements and really set out how they define the conditions for disbursements to potentially apply. Now, this is really taken from HMRC's own guidance online, but fundamentally, HMRC, in order for a disbursement to apply or to be treated as a disbursement, you need a supplier to be acting on a customer's behalf, and that you're clearly just acting as an agent of your customer. You need a customer to have received, used, or had the benefit of the goods or services that you have effectively paid on their behalf. It has to be the customer's responsibility to pay for that supply, not yours. It's just that you have paid for simplicity. You need to have permission from your customer to make that payment. Your customer needs to know that the goods or services were provided from another supplier and not from you. You need to be able to show that the costs are separately on your own invoice. And you need to pass on the exact amount of that cost, so there cannot be any markup. And the goods and services have to be paid in addition to the cost of your own services. Now, if you can meet all those conditions, then HMRC can say that the treatment of a disbursement is effectively like a recharge of a cost. You have just paid for it, but you have not received it, and you are just passing on that cost to your customer. Typically, in those situations, you would expect the invoice to be in the name of the customer and not in your name. That would obviously be a giveaway as to whether you think that could be who you think the recipient is, and whether you think that could actually be a disbursement or not. So obviously that is HMRC's policy. That hasn't changed, but obviously there has been cases that have come out recently, which we'll now move on to. So the first one we wanted to bring up was British Airways PLC versus PROSA. So this came out relatively recently, which looked at a claimant, PROSA, who had effectively suffered an injury at work and had to and basically requested a claim from British Airways, from his employer. Now, the solicitors that he employed, requested medical documents from a medical reporting organisation, and they were basically employed to get the medical documents that needed to look at the injuries incurred by PROSA and really understand what had actually happened to him. Now, that was charged on their admin fee as well as on the provision of the documents. Whereas actually, if you're providing these documents if a GP provides these documents, these are typically exempt from VAT. So the real question that came up was whether the provision of the documents could be treated as a disbursement, or whether actually they were part of a supply by the medical reporting organisation. And the judge quite clearly said that the business effectively was not acting like a direct agent or as a postbox of the solicitors. And so it was quite clear to the judge that the supply was being provided to the solicitor, which then provided the supply to PROSA, and obviously which then tried to basically get reimbursed by British Airways. So the key there is the point around the direct agent or postbox reference by the judge. It again seems to just imply a very narrow interpretation of what a disbursement could potentially be. And the postbox point being quite key, because it's clearly saying that in order for it to be a disbursement, all it could be was that they received the documents and they passed them on. There was no real provision of a service being provided as a result of that. There was nothing being provided to that solicitor. It doesn't seem to be the case that, this wasn't the case in this situation. The judge ruled that there was a supply being provided to the solicitor. So in their view, the medical reporting organisation was right to charge VAT on their entire supply. That VAT should be recoverable by the solicitor, and then the solicitor would then charge VAT on its onward supply as if it was an expense it had incurred in providing its service to PROSA. And that also then moves us on to BRABNERS. So this was also picked up, I think, in the last webinar, and was specifically looking at electronic searches for conveyancing matters and whether that could be seen as a disbursement or not. Defendants argued that their client had asked for that report to be carried out and that actually the report belonged to the client and not to them. So, on that basis, they thought that it could potentially be treated as a disbursement on the basis that the solicitors never received that service, but they were instructed by the client to get that report, to get those searches undertaken. Again, the judge argued that actually the solicitors had to get those electronic searches done because it was part of their service to their clients, and that actually, in order to do their job properly, and in order to take all reasonable care and skill, they needed those electronic searches undertaken. And so actually, they thought that it couldn't be seen as disbursement because it was again seen as something that the solicitors had incurred in order to provide their service to their client. So we know that there's a lot of uncertainty now around the application of disbursement rules. Obviously, British Airways and BRABNERS have both implied a very narrow interpretation of the definition of disbursements. We know that HMRC have approached firms looking at the BRABNERS decision in particular, and we know that HMRC have raised a number of assessments. That hasn't been across the board. I know a number of law firms that and large law firms that haven't been approached, but we do know a number of others that have had assessments raised. We also know, obviously, the Law Society are looking at this matter, and that they've issued their own guidance to solicitors around the treatment of disbursements. But obviously noting that whilst that's a useful resource for summarising the current position on disbursements, it is not binding on HMRC, and we are expecting some change in guidance, or at least some updated guidance from HMRC, but still no word as to when that will be released. So where does that really leave you? I think there can be, generally speaking, a wide interpretation of what a disbursement is, and I think that there can be a situation where a lot of costs can be just automatically attributed to a disbursement without really giving it due thought, and that might be because fee earners themselves can often raise invoices rather than it being passed on to the finance team that can properly assess whether disbursement rules apply or not. So really, the key for us is basically making sure that you take a robust position and that you document that, so that in case of updated guidance from HMRC or in case of an inspection from HMRC, you can show the policy that you have on this matter. You can show, obviously, that you're trying to apply this in a strict way, and that you're trying to apply it in the correct way, particularly relying on the test that we highlighted before from HMRC, as well as considering cases like BRABNERS and British Airways, and then having that all documented. So at the very least, if they do disagree, then you can show that you've taken reasonable care, and that will go a long way in terms of trying to manage penalties in case HMRC do disagree with the position that you've taken. So one other point that we wanted to bring up was also on delegated authority contracts. So this is in particular for law firms where they provide claims handling services to insurance companies. Now, typically, if you meet certain conditions, those supplies can be exempt from VAT, but HMRC has been very strict on that. They need very explicit wording and authorization in terms of contracts to ensure that you do have delegated authority to provide those services, and it's been an area of focus for HMRC for a number of years. So the key is really looking at whether you think you meet the conditions more generally for claims handling services, but also whether actually you think the contract that you have allows you to exempt your services. So this is why we mentioned care needs to be taken around whether you think the supply can be exempt from VAT. So one, Does it meet the definition for claims handling? And are you under a delegated authority contract that allows you to provide claims handling services? If there's any scope creep, or if there's any scope for you to potentially review, for example, claims that are in excess of a limit agreed by a delegated authority contract, then unless you have pre-approved and agreed a new contract with your insurance company, then those services could potentially fall to be taxable because they are not under the scope of your delegated authority contract. So the other point to look at is, have any other services been provided? So for example, any sort of admin services that you might provide, or any sort of investigation or advisory services that you might provide. If that is all wrapped up into a general service that you have been providing of legal support, then arguably that could be seen as a single supply of taxable services. However, if you could say that actually there's only a small amount of admin being provided with your VAT exempt services or claims handling, then that could potentially still be exempt from VAT. But again, it needs to be considered to see really how is that being invoiced, how are you billing your clients, and what are you really providing. Now, one of these other points is around pre- and post-litigation support. So this is looking at situations where a law firm could obviously deal with claims handling, but then could potentially also get involved with actual litigation if there ends up being some sort of disagreement with the claimant. The key there is looking at where you would draw the line around what is seen as litigation support, so post-litigation or pre-litigation, and effectively the idea being everything pre-litigation could be exempt, but if you're actually now supporting around potential litigation services, that would be taxable. And then this all then feeds into invoices for mixed supplies, which is looking at how you bill your clients and whether you think part of it should be exempt or part of it should be taxable, and whether you are applying an appropriate apportionment or not, and if that's done on reasonable grounds, or if there's any apportionment being done at all, and whether you think that that needs to be done or not. And then obviously speaking more widely, if there are exempt services that are being provided by the business, then what impact does that have on your VAT recovery? So could that, for example, result in a restriction on your input tax? So moving on to VAT grouping, so this is a relatively recent change. HMRC did announce a while ago that they were changing the rules around VAT grouping because previously it was only allowed for corporate entities. Since 1st November 2019, that grouping was extended to partnerships and sole traders and Scottish partnerships. So now those entities or non-corporate entities can also join a VAT group. However, they need to be in business, and they also have the same sorts of conditions around control that you would need to be thinking about. So, for example, if a partnership owns a company, it needs to be clear that that partnership controls that company in order for you to be able to apply for a VAT group between the partnership and that company. Also, you need for them to be established in the UK or Isle of Man in order to be able to apply for VAT grouping. So again, it's worth considering whether you think any sort of arrangements in terms of partnerships would be potentially applicable to these rules. I suspect a lot of professional services firms would be set up as an LLP, which would already be seen as a corporate entity and should already be part of a VAT group if it needs to be. But if there's any other unincorporated partnerships or other sorts of partnerships or sole traders, then it'd be worth looking at those to see whether VAT grouping could be beneficial. So then, what does VAT grouping actually do? So first of all, when you enter into a VAT group and there are multiple entities in that VAT group, they would all be seen as a single entity for VAT purposes. So that has a number of implications. One, that means that if there are supplies going outside of the VAT group, then that would just be seen as being made by a single taxable person, not by various entities within the VAT group. Also, transactions that take place within the VAT group would be disregarded for VAT. So those wouldn't be treated as a supply for VAT purposes, so there'd be no VAT there. Also, and this often ends up being a bit of an issue with a number of entities, there will be joint and several liability for VAT debts. So that will mean, obviously, if there's any sort of situation where a VAT debt has not been paid, then HMRC can go to any other member of that VAT group and seek recovery of that VAT from them as well. And then finally, this is more of an administrative matter, but when you set up a VAT group, you would get a new VAT number because you wouldn't be able to transfer your existing VAT number. And in that case, you would need to start thinking about, do I need to think about updating my suppliers? Do I need to think about updating my customers with my new VAT number? What do my invoices look like? What do my letterheads look like? Things of that matter. So it's more of an administrative matter, but you would need to start thinking about updating your clients and potentially looking at whether any rulings that you have or any special methods or decisions that you're relying on from HMRC, whether they still apply, because potentially those would relate to an old VAT number, to an old VAT registered entity that in HMRC's eyes no longer exists. So it would be worth looking more widely at what you are relying on and whether you have any simplifications or rulings from HMRC to see whether you need to reapply for those. So now moving on to place of supply. So this is obviously an important matter because the place of supply rules, particularly around services, determines where VAT is deemed to take place, or where supply is deemed to take place, and with that, where VAT should be charged, and also who is responsible for accounting for that VAT. So the general rule for B2B supplies of services are treated to be where the customer recipient is based. So in this case, if you have a professional services firm in the UK providing legal services, general legal services to a business in France, the place of supply would be treated as where the recipient is, i.e. France, and that would be subject to French VAT. Now, instead of the UK business accounting for French VAT and registering for French VAT, the customer can self-account for VAT under the reverse charge. But that would require you as a supplier to invoice with a reference quoting the reverse charge so that the customer knows that they have to apply the reverse charge themselves. On top of that, though, there are exceptions and there are rules that override that. So, for example, if you're providing supplies to individuals, the place of supply would be typically where the supplier is. So again, if we want to take that example, you have a UK supplier with an individual in France and you're providing general legal services, then the place of supply would be the UK. It would be subject to UK VAT, and you would have to charge UK VAT to your customer. And then there's also another exception around other types of professional services that you're providing to entities that are or to individuals that are based outside of the EU. So this is again B2C. In those situations, the supply can arguably be outside the scope of VAT, and you would not have to charge local VAT on those supplies. More widely speaking, there are obviously land-related services. So these are obviously transactions that are inherently linked to a piece of land, and then the place of supply would be where the land is located. And that in itself creates an issue, because then there's a question around whether you as a supplier have to account for local VAT or whether the customer can self-account. And that ultimately depends on whether the customer has any obligation to be registered in that country in which the land is situated. So to take an example, you could have solicitors in the UK providing, again, legal services, assuming it's land-related this time, to a business in France, but the services relate to land in Germany. In that case, there's arguably a German VAT registration obligation for the solicitors in Germany if they are providing land-related services that relate to land in Germany. So then this effectively creates quite a lot of complexity, because where do you draw the line between what is a land-related supply and what is not? And this has been discussed with the CIOT, it's been discussed with the European Commission, and so there is some guidance on this, but it's still not really clear-cut. But to take some examples, these are the list that we've set up on these slides are typically examples of land-related services, so drawing up of plans, site security, construction, legal services in regards to transfer of a title of the property, or for the establishment of interest in immovable property, or drawing up a contract to sell or acquire immovable property. That could all potentially be land-related, and so you really need to consider what will be the local VAT implications as a result of that. So what could not be land-related? So, for example, advice in regards to a property contract, or enforcing a contract, or proving the existing of a contract, or general asset management services, those may not be seen as land-related. Things like valuation can be seen as land-related, but we have seen instances where a professional services advisor has effectively done a valuation report for the purposes of looking at whether the rates charged on a property are reasonable or not. So then that draws up a question as to whether we think the service is land-related as a valuation of a property, or whether actually it's more like tax advice. So that's really a key question that you would need to consider as well. So if there's anything that you think is potentially related to property, flag that up and then see whether you think that could potentially be land-related and the associated VAT implications as a result. So moving on to some other hot topics that we've generally found and tend to be an issue, an ongoing issue really for businesses. Deal fees. So this has been an issue for a number of years with HMRC, with a lot of case law coming up on this point, which has really kind of shifted what businesses need to do to make sure that they can look at, they can recover input tax that they're incurring on deal fees. And obviously deals can include anything around a transaction, so a purchase or a sale. It could refer to a refinancing or reorganization. It can basically deal with any sort of transaction where there's a big reorganization or acquisition really. And fundamentally, HMRC typically question whether the VAT can be recoverable for one of two reasons. One, because they think maybe the entity that's paid the invoice isn't actually the recipient of the services and is just acting as a payer. And two, the entity that has received the invoice does not have an economic activity that allows it to recover VAT, i.e. it doesn't make supplies in order to allow it to recover VAT. So what do you need to think about in that situation? So we've thought about some points here. So, for example, a recipient has to be contracted, has to be on the contract for the service. So it needs to either be novated to them, or they need to be clearly noted on the contract to say that they've used and they paid for the supply, and that the invoice deliverable is all to them, and that they are owed a duty of care. Now that can obviously be a bit complex, particularly when you're getting banks involved, which will also want their own duty of care for services. If there's a BDO, then it needs to intend to make or make taxable supplies, and that's typically by way of management services. So we would typically see a management services agreement in place, and that would be the case even if BDO is VAT grouped with its subsidiaries. There's also wider questions around consideration for those fees and whether those are commercially realistic and genuine. HMRC have climbed down on that. Before, they were expecting deal fees to be recovered over a course of 5 to 7 years. That was effectively just an arbitrary figure that HMRC had come up with. But now they've just said, well, actually, the fees need to be genuine and more than nominal. Again, question around what is more than nominal, potentially going to be subject to more case law in the future. Now, where management fees are contingent, then if it's based on the future profitability of the subsidiaries, then that won't entitle a business to recover VAT. And finally, if all subsidiaries are not being charged, then there's potential scope for input tax to be restricted. And we have seen HMRC query that as a result of CJEU case law. So there's a lot of points to be considering. And obviously, if the key thing is, if you have a transaction, obviously give Anna a call or just speak to us just to at least get an understanding of what the position is, how much VAT you're incurring, and whether we think there's a potential risk around VAT recovery. So moving on to Brexit, we've got just 3 points on here because unfortunately it is still quite unknown as to what Brexit will really mean and how it's going to be delivered. But we just wanted to raise a couple of points. Generally speaking, as a service provider, as long as you are not a regulated service provider providing regulated services in the EU, you should be okay. If you have a VAT registered, or if you are VAT registered overseas in another EU member state, you may well need fiscal representation. That is a bit of an issue because that basically requires another entity locally in that EU member state to have joint and several liability for your VAT. And so often that means you obviously have to pay a fee for fiscal representation or some sort of guarantee to make sure that they're covered in case something goes wrong. If you're utilising the MOS scheme, so the mini one-stop shop for electronically supplied services, as part of the UK, we will obviously no longer be part of the EU, so you'll need to look at using the non-union scheme, and that will mean applying for the non-union scheme in the EU. Typically, we advise going to the Netherlands or Ireland because they're generally quite good with English and also a bit more approachable when it comes to dealing with the tax authorities. Tour operators, so there's potential scope that they may be able to zero rate supplies in relation to EU transactions, but that's still all up in the air. We know obviously a lot of architects can incur costs overseas, and that can incur local VAT because they think it's potentially land related. Obviously there's a question as to whether their own supplies could be land related, but assuming that it's not, if they're incurring VAT overseas, they can submit refunds for that VAT. Currently they can submit an online refund through HMRC's portal, which is a relatively straightforward process. I say relatively because it can be difficult depending on the EU member state of refund. But going forward, post-Brexit, that will become a lot more difficult because you have to go through a paper form that has to be submitted directly to the EU member state of refund. That in itself creates issues around language, but also around the requirements. So, for example, you will need to be able to provide a certificate from the year that you're making a refund, showing that you were in business. You would need to furnish the original invoices, and you would need to meet the conditions that they have around deadlines and so on. So that can become a lot more complex, and also you need to they will only typically make a payment if there's a reciprocal agreement between the UK and that EU member state, which at the moment we won't have because we're currently part of the EU. So there could be an issue around seeking refunds in other EU member states. So our advice would be, whilst we're still part of the EU, and if you're incurring a lot of VAT overseas, to make your VAT refunds prior to Brexit, so that you can get it within the process before it becomes a lot more difficult. And then finally, just picking up on some of the other points that we had that is worth thinking about. So the domestic reverse charge for construction services. So that was meant to come in this year. It was at the very last minute extended to 1st of October 2020. Now, obviously, as a lot of professional services firms shouldn't be providing construction services, but you could be an end user of construction services. In that situation, that should be charged to you because you're the end user. The domestic reverse charge should only apply in situations where the costs are basically being recharged up to the point that there could be potentially an end user. But there's also a requirement potentially for the end user to self-certify that they are indeed the end user of any sort of construction services. So that could be where the requirement kicks in for professional services firms. Unfulfilled supplies. So this typically looked at situations where a prepayment was made for a supply that was not delivered because maybe an individual did not turn up for a supply. Typically we're talking about hotel fees, aircraft fees and things of that nature. In those situations, previously HMRC accepted in certain situations that if they didn't turn up, there was no supply and therefore no VAT. Since 1st of March 2019, HMRC have taken the view that VAT is due because there is a supply, it's just that the person hasn't actually been there to fulfill it. Now, that's a slight difference, and there is It's an interesting take because there is case law that would go against HMRC's position, but they have got one position where they've looked at one case where it's been in their favour and they've just applied that. Finally, there's also the 4 quick fixes that are being implemented from the 1st of January 2020. This primarily relates to businesses dealing with EU supplies, so cross-border supplies within the EU, where they're dealing with goods. In that situation, there can be some inconsistency around the application of VAT and which ones can be what supplies can be zero-rated, which ones can't be. If you deal with any cross-border supplies of goods, either from the UK to the EU or within the EU, so say for example France to Germany, then it's worth considering how that applies, how the quick fixes apply, because that is meant to standardise the rules across the EU. Now, one particularly interesting rule has been that the EU will now say if you're making a cross-border supply of goods and you are zero-rating them, you need to have your the customer's VAT number before you raise your invoice. And in the UK, we need to quote that VAT number. But secondly, you need to be able to include that transaction on your EC sales list in order to get benefit from the zero rate. So if you don't quote that transaction on your EC sales list, then HMRC or another tax authority can question whether VAT should be due and then say, actually UK VAT is due. And it would be difficult to then claim that back from your customer, because obviously their understanding would be that they think it should be subject to VAT. Now that puts a lot more responsibility and a lot more importance on the submission of the EC sales list and making sure that all the transactions that you need to report are on that file. Because obviously before it was just statistical reporting, and so it was important, but beyond a few penalties, it was not going to create an actual tax issue. Now it can create a tax issue if you're not filing that correctly. So again, if you have any sort of supplies of goods, give us a call and we can talk through how those quick fixes could apply to you. And that is the VAT update from us.
Wonderful. Thank you very much, Ishvinder. We've got a few questions, so thank you very much. There's a number of points in there for people to really focus on in terms of the things to focus on now, which I think would be very useful. So first question is around reverse charges. And the question relates to whether or not you put a reverse charge in respect of all of the reverse charges at the end of, say, a quarter end, or whether you need to put separate journals in for each relevant invoice.
Yeah, so that's an interesting question. So HMRC's guidance hasn't actually said. All they've said is that they expect individual transactions to be reported as a sale and purchase. From that, I would take that to mean reporting it individually, but then that would mean for obviously that would also help you with visibility, so that you'd be able to see whether transactions have been properly reported or not, rather than trying to, for example, if you did a single journal at the end of a month, then trying to unwind that one transaction, for example. I suspect HMRC's intention would be that you would enter in an individual purchase and an individual sale to ensure that it flows through.
Yeah, and they're really looking for that audit trail, aren't they, based on Making Tax Digital.
Yeah.
Which leads us nicely into a Making Tax Digital question. And you set out a number of different things that you suggest people do in order to make sure they're compliant around Making Tax Digital. But what would you suggest to somebody who thinks they've done the right thing? How would they make sure they've got more comfort that they have done the right thing?
Yeah, good question. So I would say the key for me would be mapping your VAT return process. So it's really understanding where you're getting all your data from. So obviously sometimes it may not be from the same system. It could be coming from various areas or various different systems. You know, understanding if there's any sort of manual entry of data, so for example manual invoices and things of that nature, and then just mapping that whole process out so that you can see how the figures from your system or systems get reported into your 9 boxes, and then how that then gets submitted to HMRC. If you can map that entire process, you can then see where are really going to be the pinch points around potential compliance. That might be because, for example, you copy and paste a report from one Excel spreadsheet into another. That won't be compliant with MTD. It may be because you make some manual adjustments to the data that you put through. Again, that may not be MTD compliant. And it may be, for example, when you do a sample review of invoices, when you're checking your purchases, that there might be some corrections. Again, if you put those through and don't put those through or correct the original entry or correct those through via some means of journal, then that wouldn't be compliant with MTD. So for me, because I like to think visually, I think mapping out that whole process and understanding how that works will be really important. And also, it kind of does two things. One, you can obviously look at whether you are compliant with MTD, but also from a wider controls and process piece, you now have a document setting out how you prepare your VAT return. And that will be very powerful when it comes to any sort of inspection with HMRC, because then they will be able to look at your VAT return process and see that it should be a robust process.
Sure, yeah, and that audit trail is becoming more and more important, not just in VAT, but other areas as well.
Yeah.
Okay, you mentioned the deferral letter, which a lot of people were obviously very pleased to receive when they received it. What if you're in a situation where you believe you might be one of those complex businesses that should be able to defer the starting point for Making Tax Digital, but they haven't yet received a deferral letter? What do they do? Yeah,
so our advice would always be speak to HMRC on the phone, get on the helpline. At the very least, they can confirm whether they can see a copy of that letter on your file. Now, we have had situations where HMRC have refused to then email that letter over or fax that letter over, more to do with system issues than anything else, which is a bit unfortunate. But at the very least, if you then got verbal confirmation from HMRC that the letter has been sent, then you can at least rely on that, or at least then send a letter to HMRC General Inquiries team to say, we understand that this letter was sent to us, we weren't given it or we didn't receive it, please can you send it again? And then you have it for your files. The problem that I have is that because HMRC didn't issue these letters to everyone that is affected, originally they said that the letter is the document that allows you to be subject to the deferral. But then when they realised that not everyone had received it, they said, well, you may not be able to, you don't necessarily need to rely on it. The fact that you're in the VAT group or the fact that you're on payments account is enough. And then again, came back to saying, actually, no, you need the letter. So for us, it's get on the phone to HMRC, and then from there you can decide whether you want to request the letter again or make sure that they issue the letter to you if they haven't already done so.
Yeah, this is the issue of wanting to make sure that you're compliant as much as you can be, and having evidence. Even though you may feel like you fall into it, the fact that there was a letter available makes you feel like you're in a worse position if you don't get that letter.
Exactly, and to pick up on the soft landing period, the other reason why the deferral is important is because obviously if you are meant to be compliant from 1st of April 2019, then that means you only have a year from that point to make sure your digital links are all in place. So you have until the 1st of April 2020. So if you haven't got that letter, then arguably HMRC will be expecting you to have digital links in place for the 1st of April 2020. So it'd be important to make sure you have that letter so that also the soft landing period is also deferred to 1st of October 2020 as well.
Okay, wonderful. Well, that's the end of the question, so thank you very much for that, Ishvinder. Thank you very much for everybody listening. And as I mentioned, this is the end of the webinar, but we will send you the slides and the recording in the next few days. Thank you very much.
Thank you.